Welcome to the podcast about investing in startups, where existing investors can learn how to get the best deal possible. And those that have never before invested in startups can learn the keys to success from the venture experts. Your host is Nick Moran, and this is The Full Ratchet.
Welcome back to TFR for another edition of Investor Stories. On this segment, the experts talk about a startup that failed and the causes of that failure. Here's the segment called Post-Mortems. On today's special segment, we have John Vrionis of Unusual Ventures. John, can you tell us a story about a portfolio company that failed and why it failed?
Yep, I've lived through a few now, Nick. Been doing this long enough. So I want to just say, categorically, where I can point to failures and having consistency in terms of why they failed, it's because they were just too early. We got it wrong as it relates to the why now. So I had a wonderful company down in Austin, Texas called Click Security. Terrific founders. Terrific. They were using machine learning and some artificial intelligence ideas to help people with threat detection in enterprise security. And they were, I think, 100% right directionally. But, back to the comment I made earlier about startups raise money based on hitting key milestones. They couldn't show enough proof of traction to raise subsequent financing. And so we had to sell the company for much less than any of us wanted to. And it was because they just hit the market way too early. They were talking about technology and use cases that largely the market was not ready for. And there weren't enough early adopters. So we couldn't get to the revenue milestones that the subsequent investors wanted to see, despite having a very talented team and what I think is a good idea. I say that because there are a number of very interesting companies today, fast forward 6 years later, who are succeeding with a similar strategy, but they were just at a much more opportune time.
On today's special segment, we have David Horowitz of Touchdown Ventures. David, tell us a story about a portfolio company that failed and why it failed.
Yeah, I probably feel more comfortable talking about, just in general, why companies fail rather than talking about a specific company. And
Sure.
My philosophy is, usually companies fail because they run out of cash, which is pretty straightforward. So typically that means the CEO or CFO and management team spending more money before they've really figured things out, whether that's product market fit or their sales and marketing strategy. There's a question related to, well, should you bootstrap? Should you raise extra capital? I'm a big fan of raising the extra capital. I think good companies need more capital to expand. Bad companies need, bad or struggling companies need more capital because they're, obviously needed to support operations. I think the great CEOs know how to manage the cash and know when to spend it, know when they're getting a return on investment of the investments and hires that they're making. So what I really focus on, and probably more so than other investors, I really train our team to, build the financial models that really project what the burn rate is, what the cash out date is, how much cash the company needs to get to break even. I tend to be very hyper focused on this. I obviously have a financial background. I don't subscribe to the theory that venture doesn't include rigorous financial due diligence. I really believe that that's a way you can, it's obviously very hard to do it because it's hard to project, what the revenues are going to be, let alone next quarter, then, 2-3 years out. But I do think you have to do something to help you reduce this risk that I'm mentioning here.
On today's Investor Story segment, we have Cyan Banister of Founders Fund. Cyan, can you talk about a portfolio company that failed and why it failed?
Oh gosh, a lot of them have failed. I failed as a founder and I started a company and failed. So I know intimately how hard it is to build something successful. And I know that a huge portion of the companies we invest in will fail, especially at the early stages. I don't know. I don't know if I like characterizing it that way. But one of the ones that upsets me the most was a company called Game Crush. And Game Crush stood the chance to be Twitch, basically. Wow. And they were way before Twitch. And they had this idea you could pay to play video games with girl gamers. I don't know. It was brilliant, and they were in private beta, and they were doing for their stage a ridiculous amount of revenue in private beta. And then what happened was they were influenced by some of their investors to move away from their core business offering and to try to become more broad than they needed to be at the time. I personally think they should have stuck to the, I'm paying, and I'm not afraid or shy of investing in controversial things, but I really think they should have stuck to this whole thing where you're paying to play video games with really amazingly talented female gamers.
Sure.
They just moved away from that, and they kind of, as Scott and I like to say, they killed their golden goose. I think what they would have discovered if they'd stuck to it is that they had invented Twitch.
Wow.
But unfortunately, that didn't happen.
That will conclude this installment of Investor Stories. If you're enjoying the program and would like to see it continue, take a moment and leave a 5-star review in iTunes. Also, if you'd like updates on new content from TFR, as well as the top 10 VC articles every week, go to fullratchet.net and sign up for the newsletter. Okay, that will wrap things up for today. Until next time, over-prepare, choose carefully, and invest confidently. Thanks for joining me.